But you have the global strategy, which is at the top. This global strategy is made of 3 different strategies, which are the CTA component, so on your side, CTA component, the tactical asset allocation component, and the relative value volatility strategy, right? And this is the short vol component, this one. Now, inside the CTA, you have different asset classes. So I separate them by sub-strategies by asset class. So you have commodities, equities, bonds, FX. Within each asset class, you have separated between purely trend following idiosyncratic and trend following relative value, right? And below this, you have finally the models with each, let's say, parameter set.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome back to the Algorithmic Advantage podcast, everyone. Happy to have you here. My name is Simon. Of course, I'm joined with my co-host, Rich. How you going, Rich?
Very good, Simon.
Excellent.
Great to see you. And hi, Joris. How are you?
Hi, Rich. I'm doing pretty well.
That's great.
Hi, Simon.
We're joined by G'day, Joris. We're joined by Joris Bastien, and he hails from the countryside of South Carolina. We're happy to be talking to him today. He's got a vast and rich experience, which we'd like to jump straight into. So, Joris, tell us a little bit about your journey, your early history, how you got here, some of the steps along the way, and we'll just ask questions as we go. So where does it all begin for Joris?
So first, I mean, it's a totally unexpected journey. It was not planned at all. I'm kind of a leaf in the wind somehow. But, I took the opportunities like they came. So the way it started, my education is in math and probabilities exclusively. And when I had to find a job, just because I didn't want to go into academia, because I wanted to have a real job and do something real, I had a couple of options, and finance was a good option for me, just because I was I had studied Ito calculus for option pricing, that kind of thing. So I thought it was a way for me to use that. But I started as an IT developer for a software company and moved rapidly to the IT department of the equity derivatives trading room of SocGen in Paris. Did a couple of years there as an IT developer, became an IT project manager with larger teams until it was not fun anymore. And so not too much politics if you want exactly to know. So it was not fun at all. So I decided, I looked for opportunities inside the bank, and that's how I switched from the tech side to the business side. Because I joined Lixor Asset Management at the time as a hedge fund analyst. And given my background in IT and my education in math, I was given the task of reviewing all quantitative hedge funds, from long, short, statistical arbitrage equity to CTAs. So did that for not too long, actually, for maybe about 2 years. It was very interesting, very formative, because my job gave me the opportunity to discuss with many managers, many quant managers. And as a hedge fund analyst, my job was to give, a review and a risk assessment about their integration, the onboarding of the managed account platform. And based on that, I learned a lot, because they had to explain me their strategy, their risk management, their risk allocation, and basically everything that makes the strategy itself. And this is how basically I started designing my trading systems, because CTA space, specifically the trend following, I had the idea from what I was explaining that it was kind of the easiest strategy to replicate. And, as we discussed before, I didn't try to go the quant way, which is identifying factors and, to replicate that kind of thing. I said, much funnier way for me, a much more interesting way, was to try to design my own trading system that would be close enough to what these managers are doing based on what they explained to me. Yeah. And so I started doing this, for myself at the very beginning, until I brought this onto the trading desk. Well, not the trading desk, when the desk, risk management desk for the managed accounts. And we were this way, I built a kind of a CTA index, which is not the SJ CTA index. My index is totally forgotten by now. But it was close enough to most of the managers that we had. And this was interesting because it helped us understand how their positions were evolving around time. But once I had this, this window open, say, okay, I want more, obviously. And,
were you, like a lot of us, Joris, were you also looking at what other people were doing in the industry and thinking, hey, I can do this better? Did you want to trade because you wanted to make money and you wanted to do it better?
Of course, I thought that I could do it better.
Yeah.
Of course. Mm-hmm. I mean, this guy had been doing this for 20 years, but they were totally idiots.
Yes. No, I understand the thought process.
This is the always the same thing. The less you know, the more you think you know, right? And that was exactly my position at the time. So, okay, these guys, they don't know they have no idea what they're doing. So, but anyways, so I started. That's how I started designing my system. By the way, I have much more respect for the guys that I interviewed at the time than I used to have back in time. So I designing my own system, and I had the opportunity to actually meet FX manager from Paris, currency overlay manager that had also pure alpha products on the side. And it happened that I met this guy, I explained him what I was doing, and at the same time, it was a small hedge fund, small currency manager, 5 to 6 people. There was one IT in the team, and one head of research that was doing all the research. He was head of himself, basically. And and this guy was leaving the company. And given my background in IT, in maths, I just had replicated, design systems. So the guy told me, why don't you join? And so obviously I jumped on the opportunity when they, start continuing doing some research, designing new models and testing new things. Again, very interesting, but at the time, I was totally obsessed about building a pure CTA. So I didn't want to be constrained to FX only. And so I looked for opportunities to start a CTA strategy. And that's what Crédit Agricole Calion at the time, I think it was, offered me for the equity derivatives trading room. So join them, build that CTA. And again, it was in 2007, 2008. Great time for CTAs, obviously. So I was happy. But the trading room was not as happy. I mean, it was a difficult time for all the structured products coming from banks. They were, let's say it was a difficult time. So at some point they wanted to shrink the risk and reduce it. And I was the only guy doing futures. And despite my performance, they came to me and say, okay, now the word from the management is that we have to focus on our core business, which is equities. So you either find another job or you trade equities. Your call. Mm-hmm. So, okay. So, and I've always designed strategies based on prices. it was never linked to any specific asset class or whatever. So my approach was pretty universal. I make very little assumptions about the things that I trade. Like I mentioned probably before the recording, is as I see things in two basic essential ways. You are either long volatility or short volatility, convergent, divergent, trend following, or mean reverting. Yeah. So for me, so the CTA, obviously, it was a purely trend following strategy, and it was universal enough for me when I applied this to equity stocks that it actually worked. So
Joris, just quickly, you stayed with them. That they said either do this on equities or find somewhere else. You decided to stay with them and apply this to equities.
Yes, because the marketplace, I would say, in Paris is not like New York. You just not get jumped from one hedge fund to another. There's not that many opportunities. I have my wife, kids, dogs, house, and everything. Yeah. So the easiest way was for me to try to switch to equities, despite the fact that I still wanted to run that future strategy.
Joris, tell us a little bit about that, moving into equities. How much applied? What needed to change? How did that transition go? Was that harder than you thought?
No, it was much easier than I thought. And again, because what I mentioned, I make very little assumptions about the things that I trade. Based on price. My approach is really universal. Again, very little assumptions. And so when there is a trend, I can capture it, basically in a pretty efficient way, which means that even with extra noise in many of the equity stocks, I was still managing to capture some of the trends. And it actually worked pretty well again, because, so I started this basically at mid 2009, when the market started rebounding. And there was a lot of trends on stock at that time because, it was going straight up.
Vertical ascent.
So it was kind of easy, basically, for a trend follower applying this to stocks. So, I think again, another year of pretty good performance. Unfortunately, the situation was not improving. In the trading room, there was very little direction from the management. And at some point, I got a call from Igor Tulchitsky from Quant on the trading desk at night, because I was trading Europe and US, so I switched towers. I was coming at the office at noon. I was leaving around 10 at the close of the US Paris time. And so the funny thing is that I never took any call from headhunters, never. But at this time, there was lack of direction from the management in the trading room. I was bored that night, and this time I picked up the call. Why? Don't ask me. That was the first one and the only one, actually.
Nice. So before we go into World Quant, Joris, before we go into World Quant, can I just ask, I'm sure the question Rich and I would both have about moving from futures to equities, especially in a trend following environment, would be dealing with the nature of the fact that stocks are so much more correlated. Now, obviously, there's a lot of instruments on a day-to-day basis. They're not necessarily that correlated.
Yeah.
But when things go bad, then stocks tend to be highly correlated. So was that something that
has
featured?
And this has been a defining thing for me later, just because I don't take into account correlations in my strategy for this very specific.
Thank you, Joris. Thank you.
No, but for the very specific that you just mentioned, it's meaningless. Correlation is meaningless because correlations work only when you don't need it. It's very nice, it's very smooth, but at the time you don't need it, actually. But what happens when you have, a massive crisis, a liquidation event, all correlation goes to one and your risk goes to the roof. So for me, that's why I believe that correlations are pretty useless in trading, at least in my side of trading. And I like to compose strategies, find diversification rather in the systems than the instruments. For me, the instrument diversification is totally passive. It's not something you control. When you're doing diversification through system, this is something that you can actually control. And if you think at what I said before, if you separate between mean reversion and trend following, these two systems act as filters on price, and you get very stable statistical features on the output of these systems the stability that you would not get in price. For instance, you apply trend following systems, that you have positive skew, very specific characteristics. Mean reversion is the opposite. You have negative skew, a higher crash risk, but this is something you control, and this, when this happens, it happens. So I prefer addressing diversification through systems than instruments.
Very good point, Joris, because structurally you can apply logical design features that enforce an uncorrelated nature between system elements as opposed to the fickle nature of markets where you have no control over correlations of the markets themselves.
Yeah,
so with the structural design, that is a way to enforce a degree of uncorrelated properties within your portfolio. I totally agree with you there.
Because, so most of the managers that I saw and I interviewed at the time, basically they had one or two trend following models, and their concept of diversification is to implement this on hundreds of different instruments, and that's what they call diversification. I think it's not intellectually satisfying, if I put it that way, right?
Joris, before we get onto the World Quant, you mentioned that when you came into this equity style, you're looking at both long vol and short vol. So can you explain how you were using this and describe the long vol and short vol strategies?
So at the time, I was still what I call long vol trend following, right? This might not be, so some people, for instance, would disagree about the long vol nature of trend following. But for me, it's more volatility, long volatility, like volatility expansion. If you consider, there are many ways to assess the volatility of a market. So you have the pure statistical volatility that you can define. Another way to see volatility is purely the range, a Duncan channel range. This is also a measure of volatility. And so when you have a trend that is developing, the range expands, and that could be seen as a volatility expansion, kind of. So that's why I categorize trend following into the long volatility space. And at the time, I was only running trend following strategies, not short volatility strategies on equity. This came later at Quant, actually. But again, like we mentioned before, the 2009, 2010 were very trendy, even for stocks, because the liquidity injection from the Fed, sent everything rebounding like crazy. So at this time, it was pretty easy to have that kind of system working. Yeah. So like I mentioned, I got this call. I got two small interviews with Igor Tupczynski from World Quant, and he asked me, "Do you want to move to the US and trade for us?" And to be honest, I never thought that it would happen because I never thought that my wife would accept this. And when I came back home, jokingly, I went through the interview process with World Quant without telling my wife, because it was something that to take me out of boredom at night, basically, when I had nothing much to do. But one night I came back home and I said to my wife, "Oh, you want to move to the US? I have a job offer there."
This is where the bribery commenced.
and to my biggest surprise, my wife said, "Why not?"
Yeah.
And I said, "Okay, we are in trouble now."
Maybe moving from the French countryside into Paris was wearing thin. City life in Paris was getting a little bit too difficult.
But it's a time where both my wife and I we probably wanted to do something else of our life, because at that point, because of my different experiences in IT, and so switching to Lixor, and then my little experience with the FX manager, and then joining Calion. Then at the time, I was already pretty old. I was not the 24 anymore, just trading. So I was reaching. So I got this offer from Quant. I was turning 40 already. And so I said, so I have one choice, which is staying where I am and do the same thing for the next 20 years until I retire. And this is not something I could imagine. So I definitely wanted to take that opportunity, see something else, because the idea was, to me, was okay. If I don't go, basically my life stops there. and so I accepted the offer. We moved to the US in a couple of months. So I moved first. My wife joined me. It was kind of a bit stressful to be honest.
Joris, can you just quickly describe the world quant structure? So how does it operate?
So I don't think I will disclose anything proprietary there, but it's a factory. It's an industry where you have a lot of researchers, quant researchers around the world that are whose job is to design what they call alphas, which are strategies, a set of signals that gives you a position. This is an alpha. And on top of that, you have portfolio managers whose job is to aggregate these alphas into strategies. For me, it was really interesting because probably because of my education and my experience in IT, I have the bias of always trying to structure everything that I do like crazy. It has to be square somehow. And so I had this idea from the very beginning to build an industrial process for strategy design, strategy creation. And when I joined Quant, I said, "Oh, this is the place," because they actually do what I wanted to do, and it works.
They weren't happy for you to work remotely. I would have thought a lot of the World Quant staff were just remote.
Now, probably yes. At the time, so it was so I joined them in 2011, and at the time, I didn't know of many people working remotely.
And Joris, can they make it beneficial to the trader by paying performance fees, or is it sort of more of a subscription?
Yes, I have to say that Quant is the fairest company that I've worked with. I would never say anything bad against them, even, so they let me go at some point. And I managed to survive about 5 years, which is not so bad. But they are very fair and very honest. I mean, what I like about them is that they respect the contract, not only to the letter, but to the spirit. When Igor says something to you, you can trust him. And this is, I think, to me, that's something that is invaluable, just because, I've had so many bad experiences. There's always a good reason not to give you the bonus that you think you would get. Specifically in an investment bank, there's always very good reasons, and you never get what you think you would get.
It's a bit like an insurance company where you're always paying insurance, but they rarely pay out.
Yes, I mean, yes. When the house burns, say, okay, you didn't see the little line here or there. Sorry about that. Yeah, that's the kind. But no, Quant is the fairest company I've worked with. Totally trustable.
And what
but
about
they
IP?
have very high expectations. That comes with and again, I have nothing bad to say about them just because I knew what the expectations were. They respect everything that they said that they would, give me in terms of, trading capacity, bonus.
Joris, you mentioned these spectacular Sharpe ratios that were coming out of World Quant. So if we could imagine these thousands of alphas which are coming into the firm, and then the allocation side is how to structure those alphas together.
Correct.
And which ones to use to create the portfolio.
Mm-hmm.
So can you tell us a bit about that and some of the spectacular Sharpes you were seeing and how that could be justified?
I've seen this with my own eyes, and this was it's a machine, right? It's a machine that is working very well, that is very well structured, and there's a lot of smart intelligence put into there. The guys that are working for World Quant, I've never met a dumb guy or a stupid guy in World Quant. They are all really, really smart. And I love being there just because you're surrounded by so many really smart people that come from very diverse backgrounds, from technology, from purely research, academia, you name it. It's the level of intelligence in this company is insane. And so when you gather, and again, they are hiring people from around the world, so mostly the best. And when they also have offices around the world, and when they are tapping into the massively good education systems of India and China, who are producing engineers by the 100,000s every year, who are massively, extremely well educated, you have access to a pool of intelligence that is crazy. And I think
model.
that this is something that World Quant does really well, to give the opportunities to know how to identify these places where other hedge funds maybe don't go as much. Because if you think about India, for instance, it's mostly IT development from the Western side, but very few are tapping into the intellectual power that they have locally, and so they have access to a massive amount of brain power from very smart and very well educated people. And when you see this, you say it makes sense. Because I've not seen that kind of structure to explode that kind of amount of brain power anywhere else in the hedge fund industry.
I just worry because, I remember long-term capital management had a Sharpe of 2.6, and we know what happened to them. And they had a couple of Nobel Prize winners in there.
Yes, but there's I don't think there's any Nobel Prize. Maybe they are, probably not, because that's not what they're looking for. But the difference with LTCM is that these guys, basically, it was not a really large team, LTCM. They had a couple of guys that are very strong ideas about how the market should be. And so coming from academia, you're not looking at the world the way it is. You are looking at the world the way it should be. Let's say within the normal distribution world made of normal distribution, and as soon as you go out of the normal distribution, you eat a fat tail, you're done. That's what it is. I think it's totally different and totally not comparable at this point.
Okay.
Joris, I recently passed around a paper written by the World Quant team, I think, in the Real Test forum. Real Test is a backtesting engine that I use. It's called 101 Formulaic Alphas, I think. That's a paper of World Quants with 101 alpha ideas. Yeah. I did notice they're very brief, very sort of one-line ideas. I'm not sure how how much I could do with that. Not that I looked into it in great depth yet.
I mean, I'm not concerned about that just because, and I would agree, the best systems are the simplest systems. And then, if you have, you can extract, a little bit of alpha, even with a one-liner, but you combine this with hundreds of thousands of one-liner like this, where each one contributes a bit of alpha. It's like a high frequency strategy.
Yeah.
You will not make it massively, but you just combine every little bit that you add and you add and you add and you grind and you grind and you add and you add, and at the end of the day, it gives you something that is massive. It's just an accumulation at an industrial level.
What I like about it is with hundreds of alphas working at the portfolio level, in effect, you're trading very small bets for any individual alpha at the portfolio level. So really, that is your ultimate form of risk protection, the very small bets allocated to each individual alpha. So even if they do have a negative skew event on a couple of those individual alphas, overall of the portfolio, it's going to reduce that impact.
Yes, because you can argue that in that kind of strategy and industrial based style strategy, there's no model risk. There's no parameter risk. That is gone just because you have so many different things working at the same time. You have reduced these two risks massively. And basically, the overfitting risk is probably gone as well if you do it correctly. So I think that, that's the kind of thing that I'm trying to do as well. I'm trading a lot of ensemble strategies. I never trade one single strategy that will apply to tons of things. But anytime I implement strategies, it's not a strategy. It's a set of sub-strategies that are themselves made of sub-strategies. And then when you get to the leaf of the, strategy tree, if you like, you have the model. And so even the models, you have multiple models for one single sub-strategy at the bottom, and every single model implements a number of different parameter set, which are designed to find the most stable parameters.
Joris, just quickly, are each of these alphas, with each of these alphas, is it purely coming from price signals, or are they using alternative data like to generate these alphas?
So for Quant, I know that they are using alternative data. To which extent, I just cannot tell you. I don't know.
Yep.
I know, but I know that they're using some. Yeah.
Okay.
My thinking on that paper was just that if the alphas that they're publishing to the public are probably not the ones that they're most interested in.
But
at the moment.
even if they were, in my opinion, again, I'm not talking for Quant because I'm not habilitated to speak for them. And I think my point is that even if they disclose 100 alphas, it's only a tiny part of what they do anyway. So if you take that 101 alphas in an ocean of alpha that they're developing on the side, yes, you can probably do something with it, but you'll never replicate what they do anyway. So
we'll get you out of hot water now, Joris. So you mentioned how you worked for 5 years for World Quant. Yeah. What happened after that?
So after that, I joined a mostly discretionary hedge fund, multi-strat hedge fund that was building a quant desk, but they closed after 2 months. So I had to find something else to do. And this is how I started, because what you have to understand is that in World Quant, I went away from what I was doing at the beginning when I joined. I started going from purely directional strategies to something that was more relative value and more mean reverting, because so it's a millennium style management, which means that very tight P&L risk constraints. And I knew that with my original strategies that I joined with, I would hit these risk limits. at some point. It was not an if question; it was a when question. So I updated my strategies, trade differently with the same process, but instead of going trend following on the stocks, I started trading on spreads, trend following as well first, and then mean reversion. And so when I left WorldQuant, I wanted to go back to what I really like trading, which was, more trend following CTA space, macro space instruments.
I think an important question, Joris, like across the spectrum, we haven't really clarified whether you were trading just end of day data or whether you were trading intraday data. And I guess particularly, I'm curious whether WorldQuant operates a bit more like a prop shop where they actually do favor a lot of people running intraday trading models and trying to generate 100, 200% returns per annum, or they're actually, and were you interested still in running end-of-day models?
Well, when I was at WorldQuant, so for me it was end-of-day models, daily models, and still until recently, by the way. On the WorldQuant side, it was mostly daily strategies. I have no idea, to be honest, if they are trading intraday strategies. If they were at the time, I was not aware of that. And if they do now, I have no idea. But for me, it was always daily strategies all the time.
Okay. So you wanted to move back toward your trend following roots.
Trend following multi-strat strategy, because along the way I learned obviously many different things about trading spreads rather than idiosyncratic instruments. So I wanted to exploit that, not only trading the instruments but trading the spreads as well, because once you have the spreads, you can construct as many instruments as you want with different track record, and then get diversification from that if you want to. So again, for me, so basically that was kind of combining a purely idiosyncratic trend following with a relative value trend following at that point. Kind of Emil Van Essen plus another regular CTA, if you like. As far as I know what Mr. Van Essen does. But that's my understanding of his strategy, that he was trading relative value strategies. But anyway,
do you want to explain just briefly, Joris, relative value trend? What would you mean by that category?
It's more so you have. So for me, there are two ways to consider the trend and relative value. You can build the spread between two instruments and trade these spreads the same way that you would trade a single instrument. You trade the spread. You have, you build a spread. You have a time series. You apply your model, and if your model is good and stable enough, you should be able to capture the trend in that.
I used to trade spreads back in the 90s, Joris, in a very similar way, but in Australia. We'd be using the mining companies. We'd be looking at two comparable mining companies, going short one, going long the other. You eliminate the market risk. You're trading the idiosyncratic risk between the companies. And if you've got an opinion that one's going to outperform another, you'll get a divergence of the spread, or you might get a mean reversion of the spread, depending on the relationship. So
I mean that makes a lot of sense. I don't pretend to have invented anything, because all the things that I do, in my opinion, are the things that actually make sense. It's logical. Once you have a model that is capture trends, so you can capture it in the second trends. Now, what about spreads? And like you said, remove the systematic risk, that kind of thing. So I started doing this. Again, removed some of the volatility compression, mean reversion components to be more comfortable on the trend following and the momentum side. So did that for myself. Had the opportunity to show this to a hedge fund who was again developing a quant trading desk as well, in mostly discretionary environment. So I did that for them for 2 years before we separated ways. But that was interesting for me just because this validated many of the things that I had designed. Specifically, I wanted to trade something. I wanted to build a CTA on ETFs, if you like. So the question was, do you really have to trade futures to build a CTA strategy? The response is not. You have enough ETFs to do that. Next question is, do you have the capacity to do that? And yes, I traded about 500 millions for them at the time on ETFs that every single retail can have access to. It's basically it's an equity structure. So
what about the?
So yes, you can, and at pretty large scale, actually.
Okay. What about the fact that the futures obviously come highly leveraged with a lot more bang for your buck power to make money, and the ETFs generally don't. So did that change things significantly?
That's correct, but that's valid in the retail space, right? Because when you're in a hedge fund, you have access to leverage. So the leverage is not the issue. The leverage is an issue as a retail. Just because if you are retail, you have Reg T constraints, at least in the US. So your max leverage is 2, and if you want to diversify as much as you can, you will compress your volatility, but your returns will suffer as well. And you cannot leverage as much as you would like. Most of the hedge funds, specifically the multi-strat strategy, their leverage is around 4. This is not something that you can reach as a retail trader. And I think it's a bad thing just because it forces retail traders to actually have more risk. Because you have to take more risk to get the returns. Otherwise, you may have a Sharpe of 2 something, but if you make 5% a year, it doesn't make any sense. It's just not worth it. So for the retail space, you have to take more risk than you should, even if you know how to build a really diversified strategy. So I think that this is really a bad thing, and it's not protecting the retail.
Is it possible for the retail trader to have a go at this kind of ETF trading with the 2 times leverage, or it's not really enough?
Yes, because I did it. So after that, I went to another hedge fund, and my wife told me to quit. I was just frustrated because from all the experience that I had before. My goal at this point is say, okay, I've seen this, and this. All the building blocks are taking shape in my head, and now you're in a hedge fund doing some research, and you just cannot implement your ideas. So that's a very frustrating situation.
Very clever wife.
Yeah, I mean, she's not so risk averse that I would think. So I left. I worked on this, build this kind of strategy. Again, I have, for instance, the point we mentioned just before. I have built a purely trend following CTA, but the return. So the Sharpe is not bad, but it's a CTA-like strategy, highly diversified. So if you are purely trend following, it's very difficult to go above 1. Let's be honest. But to get 1, my return on this one was what? Maybe 6-7%. On the 1 Sharpe ratio. So that's not worth it, basically. And so you have to implement other strategies that will diversify the CTA, but will give you higher returns. So where do I get that? I get that with tactical asset allocation. And it didn't, so you have, if you only trade the tactical asset allocation part, it's
Can you explain that a bit more? Joris?
So basically today in my strategies, you have 3 main components, at least on the CTA side. You have one component that is purely the trend following CTA, very classic trend following, idiosyncratic. maybe not totally classic, but because it includes relative value, like we just mentioned before.
Yep.
So it's a little bit more diversified than regular idiosyncratic trend following strategy. But on top of that, and the second component is a tactical asset allocation strategy. And it is what it is. What is mentioned, the idea is to capture the flows between the asset classes. Where are they moving? And if they are not moving anywhere, they are moving to cash, you're going to cash as well. So again, that's momentum and trend following based. For instance, what happened in 2022, you had stocks tanking, you had bonds tanking. And so the only asset class receiving some assets at the time was commodities up to, let's say, mid 2022. I would say, and then it kind of reverted. And at this time, the tactical asset allocation, if you look at the momentum on each asset class, if you like, equities, bonds, and commodities, it was not so good, right? And so,
Joris, how are you measuring these flows? How are you getting the data for the information?
I'm not measuring flows. That's the underlying assumption. That money, the big money, they have some exposure minimums, from the big pension funds. They cannot be in cash. They have to be invested somewhere.
So you're looking at relative trend between your asset classes. Is that what you're looking at?
Kind of, because I evaluate the trend on each of these asset class. And I'm not going on the asset class if the trend is negative, basically.
Okay.
It's kind of as simple as that. So what happened, if 2022, when the market, equity and bonds started going down together and correlation between both going up, killing the 60-40 or risk parity stuff, what happened is that the asset class receiving the assets was the commodity asset class, with the oils going up. And all that stuff. So basically what happened is that the momentum on bonds was negative. The momentum on equity was negative. The momentum on commodities was positive. And so...
Joris, once you identify, say, that commodities was the only one that was positive, what would you then apply to capture that tactical allocation? What sort of model would you apply to get the alpha out of that?
It's the same trend following model that I use everywhere else. I have it's the key. I mean, I always use the same thing over and over in very different ways. That gives me some diversification. And why do I use them over and over? Just because I've used them now for more than 10 years and they never failed me. When there is a trend, these models will capture the trend. The risk management as well, the risk allocation as well. I've been using this for many years in many different situations, and I always get what I expect from them. So obviously you don't get, a straight line going up. That's not what I'm trying to say, but at least what I'm mostly interested in is that the behavior is the one that I expect. And that's really what I'm looking at in a trading model. Is it doing what is expected to do? Do I lose a little bit when there's no trend? Yes, but that's what it's supposed to happen, right? So I just cannot complain about that if I design a trend following model. So again, like I said, so for the trend for idiosyncratic trend following CTA, I'm using the same models, the same risk management to generate that CTA. For the relative value, I use the same thing. For the tactical asset allocation, my way to know where the asset flows are going is that if there is a positive trend on this one and a negative trend on the other one, which this means that to me, the hypothesis is clear, is that money is going from there to there, right? You sell one side, you buy another side. But it's always the same process applied in different views.
I like it. And Joris, you're finding your tactical allocation, that is significantly improving your results overall. That's generating a higher.
Because now you are going to not something that is totally risk managed like a CTA can be, but you are long an asset class. And so you have more return, more risk, more return, but you can still keep the return for the same risk by diversification with the CTA that you have on the side, right? And so like I said, I was getting 6 to 7% with my CTA. Now, I have a slightly better Sharpe ratio, but instead of going 6, 7, now I reach 9, 10%, which is already much sexier.
What sort of allocation would you have between your idiosyncratic trend, your relative trend, and your tactical trend, effectively? What sort of allocations?
It's a risk allocation. It's purely based on risk. It's not based on the performance on the submodels. If you like, it's the closest thing is hierarchical risk parity. So where everything is contributing the same thing, the same risk to the global picture. And in risk management, you actually need two things, because my view is that everything is contained in the prices and in the track record of your model. If you want to know, that's another point. For instance, if you want to talk about this now, is that I don't believe in regime identification, because it can vary. The regime identification can have very different impact on how you have designed your model.
Yeah.
And so the regime identification has to be closely linked to your model itself.
Okay, let me ask about regime.
You have a very clear indicator about if your model is working or not in the current condition. It's your drawdown. It's as simple as that.
Can I just repeat some of that stuff just to see if I've understood your portfolio allocation there? And I want to compare and contrast to some of our other friends who I think do it a little bit differently, where they might have an allocation across 50, 100, 200 different contracts, and their diversification is not so much model diversification, but contract diversification. And they're allocating their capital so that they're always ready to take whatever contract or whatever instrument is about to start trending. Have I understood correctly that you are willing to trade a smaller group, say, of assets at any one time, and so you're actively allocating and selecting if this particular industry or these particular commodities are not trending and not attracting capital, you don't have any allocation to them, so you've got more money to allocate to the things that you are interested in. Is that correct?
For the tactical asset allocation, yes, that's correct. But again, you have to understand that it's a really... So if I'll try to be clear, which is not my forte, you probably noticed. But you have the global strategy, which is at the top. This global strategy is made of 3 different strategies, which are the CTA component. So on your side, CTA component, the tactical asset allocation component, and the relative value volatility strategy, right? And this is the short vol component, this one. Now, inside the CTA, you have different asset classes. So I separate them by sub-strategies by asset class. So you have commodities, equities, bonds, FX. You have a little bit of volatility here, but it's more tail risk hedge. But anyways, I just don't want to be misleading there. So you have there. Then within each asset class, you have separated between purely trend following idiosyncratic and trend following relative value, right? And below this, you have finally the models with each, let's say, parameter set. There are always many parameter set. But what happens there, you have to go back the tree up to the top. When you go from the instrument where to which are applied the models and the parameter set, this gives you a performance, right? That has some specific risk, and you allocate this risk between the different sub parameters set to give you the performance of the strategy, the sub strategy. So now you are one upper level where you have an ensemble of sub strategies. Each sub strategy generates some risk. And to go to the upper level, you allocate the risk again between these two, three. So these two, because now it's idiosyncratic and the other one is relative value. Now you are at the, if I remember, yes, you are at the asset class level. And then you have the risk for each. So all these models below generate a risk for this asset class. And then you allocate equally to the risk of each asset class. Once you've done that, now you are at the top of your CTA. And you do the same for the tactical asset allocation, and you do the same for the relative value volatility. And then all of them have a risk. Generate some risk based on the trading models that you implement. And then again, you reallocate the risk between all of them. And that gives you finally the final strategy. So now you understand that it's a very high. There's a lot of technology involved in that kind of strategy, just because that kind of design and applying the same risk management process at every single level of aggregation of anything, whether it's parameter set, a sub strategy, and you build a strategy, a tree of sub strategy like this, and every time you go an upper level, you do an allocation process and risk management process and all that thing. You have to design your trading system and your technology pretty well to be able to do that. Not only to implement the ID, but to be modular enough so that it can evolve. So you have the ideas today. For instance, to me tomorrow, if I want to change the risk allocation strategy between all the models and then be applied to everything, I just need to change a couple of lines.
So Joris says this continual dynamic risk adjustment occurring throughout every level of the hierarchy of the portfolio. So
it's always
you've got these alphas all going everywhere with this. Yeah, it's a bit like a flock of birds, moving in unison, and expanding and contracting.
It's really a dance between all of them. If someone is taking a bigger risk, it will be deallocated. That allows me not to have a single strategy or a single position dominate the entire portfolio. This is exactly what I don't want to. And this is the kind of one of the biggest concern that I have about, so the turtles, for instance, so it might have been evolved. I don't know. I didn't follow. But if you take the original rules of a turtle, what I don't like is that they say, okay, risk management, you say it's 2% of your portfolio, and then you let the profits run. The issue that I have with this is that if you do that, let the profits run like crazy, then at some point, 100%, 80% of your portfolio can be made of one single position. That can happen. If you have let's say, you have utility stocks, for instance, and you have Tesla on the side. If you had trade a portfolio like this, Tesla would be 80% of your portfolio at some point. And that's not risk management to me.
Simon, ask him another question. He's turning it on me.
I'm enjoying the show, the spectacular.
I did it purposely.
I'm just going to sit out. Joris, Rich loves this stuff. And him and his mate Jerry Parker. If we had him here
I'm
now,
poking the bear.
Oh my gosh!
Yeah, I'm coming out of hibernation. Don't worry.
But I love hearing all the different viewpoints because I think we can all really learn something and continue just to grow and expand, right? We've got to be able to have the apologetic. We've
No,
got to be
you're
able
right.
to answer to the objection.
Even specifically, I really like hearing about people that are doing something really different than I do, just because this is when you learn something. So, at the end of the day, to be able to learn something that is valuable, you have to be willing to hear something that you don't like.
100%.
And to be challenged on this thing. So some of the things that you'd be said, okay, no, I don't like it, I would never do that. But sometimes you say, okay, maybe I don't like the idea, but it's probably something a little deeper than the idea the way expressed, and gives you another idea about something else. I think it's always interesting. There's a lot of things that I don't like in the way that many managers are doing. But I'm still always happy to hear what they have to say, because
Absolutely.
usually they are smart people, and you always learn something. If it's not something that you expected from the very beginning, you always learn something.
Yeah, no, that's what I like. If someone says I don't like something, I immediately get my back up and I say, well, why? Just don't say you don't like it. Explain it. Let's have a dinner together, round a table. We'll openly discuss and debate the issue. So at the end of it all, you have a total understanding where they're sitting at, where you're sitting at. It's good when you have this diatribe and this conversation, as opposed to just, I don't like that, or I like that.
The best way to learn.
Yeah.
The best way to learn is to have
something even worse about the turtles, if you want.
Yeah.
No, we can move on, Simon.
Let's do it. The best way to learn, I think, is to have to explain yourself to another side, to the other side, to explain why you believe what you believe, because you know what somebody else believes. If you don't know what they believe, you're not willing to walk in their shoes and think about things from their perspective, well, you're not actually going to be able to meet and communicate and talk together anyway. I had one silly question maybe that I might have missed in all of that, just in terms of looking at trends as indicators of, say, capital flows and wanting to follow the money and be involved in asset classes that are on the move. I may have misunderstood, but if something's moving down, that's an opportunity to short it and make money in a downtrending environment, or is that something you're saying you're actually avoiding?
No, that's what I have in my pure CTA trend for. If the trend is down, I will take the trend down. The thing is, it's on the tactical asset allocation side, it's long only. And what I want to capture again is higher volatility and higher returns, and the diversification that I get with my CTA. I could trade the tactical asset allocation by itself. I actually think that it would be a very good product for registered investment advisor, for instance. But the objective with me is not to discard totally the short side. Is to have access to larger returns by. Again, like I tried to explain, maybe I was not clear, by taking more volatility at the tactical asset allocation level, but not more volatility at the strategy level, because I benefit from the diversification with the CTA component.
And do you, at the moment, you're executing all of this on ETFs, is that correct? And do you trade any single stocks?
No single stocks. No. I don't see the value in that, to be honest. And I trade today 20 ETFs.
Okay, and why don't you see the value, say, in the single stocks, Joris?
Because it's a lot much work, much more work. I like the idea of working with a pretty limited universe that I can focus on, and that can more representative of macro play. I'm interested in geopolitics as well. I read a lot about this. like anyone, I just I have ideas that I can discuss at the bar, but that's it. I like this idea of connecting what I see in the markets on the macro side, global macro ETFs, compared to what's happening in the world. I'm much less interested in the life of companies, so the stocks. And I think that there is way too many. I don't even know how to say this in English. Things that are related to the company itself.
Really specific influences.
If the CEO cheats on his wife, it will have an impact on the company valuation. I just don't want that. There's all this kind of little thing that can impact the value of a stock. Tesla. If anytime Elon Musk sends a tweet, the stock may take 10 or 20%. So I just don't want to be, impacted by this, because these are totally random events. And I think that the game is already difficult enough like this, not to go back into that. And again, it's a lot much more work, such as, all the corporate actions, and all that thing. It's pretty annoying, to be honest.
Okay.
And because it's about, for me, so today it's a one-man show, right? So I don't have an army of people working with me on the back office to deal with the corporate action and all that kind of stuff. So I need to focus my time on the most valuable thing. And what is the most valuable time for me is the time that I spend on designing trading models, risk allocation, risk management systems. That's where the value is. My best value is when I give this,
Joris, what sort of software are you using? What's your preferred platform? That sort of stuff. What are you using here?
Yeah, because you've explained quite a complicated technology stack there in terms of how you execute.
I've developed everything myself, so I do not use any software. Everything, all the platform has been developed by myself over the last 12 years, at least now, 12, 13 years.
Okay.
Yeah. Like I said, I managed to keep my intellectual property along the years. So now that I started my own thing, obviously I still have it, and I keep building on it. I keep building different things, but the point is that I have I'm a kind of control freak as well. So I have to have control about everything. And if I need something, just because I have my experience in IT, if I need something, I can develop it.
Joris, is that all in Python, or what's your preferred language?
So it's both C++ and Python. But now the new developments happen more in Python than C++, to be honest.
And Joris, do you have automatic execution through to the ETFs, or do you do manual execution?
I do. Everything is automatic. I refuse to do anything on a discretionary basis, even execution. I totally refuse it. Again, like I mentioned at the beginning, I want to develop an industrial process. So as soon as you involve someone that is doing something manually, you're just throwing the idea out the window. So everything is totally systematic, even execution. For instance, I developed, so I don't use them now just because I don't need it, but I developed my own TWAPs for execution. It's not that complicated, to be honest. So if you have a little bit knowledge of coding, you can do it pretty easily. And I like coding. Coding is one of my favorite time to spend.
Have you? I'd love to just know a little bit more about building your own backtesting engine. And have you used some of the other off-the-shelf products? And what do you like about having your own system?
Well, the flexibility about my own system. Obviously, I can do whatever I want, the way I want. Although I've seen very good other platforms I like the platforms. So me, I'm an open source guy, which means that everything that I do is Linux based, library, open source. I never paid for software for the last maybe 20 something years, because I moved to Linux in 2004. Because I was pissed off by Microsoft, like about everyone in the world. But I said, do something about it. If you're not happy, do something about it. So I moved to Linux, and I'm Linux-based guy only.
Nice.
So I'm not using any kind of. I knew guys that were using TradeStation, for instance. They were pretty happy about that. I don't like their reporting because it's a report by trade. I don't like that. But there are open source platforms that allows you to design, backtest, and trade strategies with Python code that are pretty good.
But is your backtesting engine Python or C++? Because you really want it to. Is it lightning fast?
I mean, when you trade on a daily basis, you don't have to be really fast, right? If your system is even based,
running backtests quickly is nice.
Oh yeah, I mean, the running a backtest for me, it takes me 10 seconds maybe on a full, from the early 2000 to now, it takes 10 seconds.
So is that Python or is that C++? The backtest.
I have both. When I started developing in Python, an architecture in Python in 2017, maybe. And before that, all my systems were implemented in C++. And now my architecture is slowly moving to Python. So I have an architecture backtesting engine in C++, and I have a backtesting engine in Python as well. And now the new stuff is developed in Python.
For somebody getting started these days, there's probably they could just focus on Python, right, and just take it from there.
Yeah. Yeah, you're right. I mean, Python is it's just coding for dummies. It's no, but it's good. I mean, I use it myself. It makes your life as a coder so easy. It would be stupid not to use it. There are so many. Whatever you want to find, there are so many libraries available. You can find anything you want from, basic, let's say, technical analysis to machine learning stuff. You have the libraries to code something in Python, and it's so easy. So there are things that I don't like in Python, but it makes your life so easy. You should do it, and you. After that, the speed of the code, obviously, Python will always be slower than C++, but it has the speed of your code. It has a lot to do with the way you code it. And this requires some experience in coding to not make the mistakes that would slow down the code. For instance, I mean, with Python, you have vectorization with pandas, and so NumPy or that kind of thing. You have to use it massively to have your code, and after that, you can add a Cython layer to convert your Python stuff into a C code, which makes it slightly faster, but the most gain in performance that you gain is the way you code your engine, your backtesting engine.
Jerry's sitting here in the background saying, like, get Joris to tell us how he differs from a classic turtles approach.
Okay, so I think that the biggest difference would be let the trade run for the reason that I mentioned before. I'm more on the AHL Winton side where you would, adjust to volatility. Because you can let the trade run, but this 2% initial risk allocation, it's not risk management to me. What happens after that? You have an extra risk. The risk that you had in your portfolio when you take that 2% position, a week after, if the trend has developed, this is not the same risk.
We'd have to clarify there, Joris. It's 0.25%, but 25 basis points. But anyway, keep going.
Well, it's the same thing, it's just not about numbers. It's about the concept. But the risk is different. For me, a risk management system has to adjust all the time. Anytime you have new data, you have to adjust your risk all the time. And that's what, when I explain about what my architecture is doing, this is exactly what it does. You have all these dance between all these components, some growing, some shrinking and all that kind of thing, because the risk is always different at every time. And you have to adjust the risk every single time. That's my opinion. But I think that the main reason for that is because it's the difference between an individual investor, who is interested in the performance, versus a portfolio of strategies, right? So if you are a single investor and you want probably to maximize your return, and it's probably a better way to allocate your 25 basis points or whatever it is at the beginning and let the trade and let it run, if you can accept the drawdowns. Because that will give you higher risk. The trend reversals, you will suffer much more in trend reversals. When you are a single investor, that's probably what you want to do to maximize your return. Now, if you are in an allocation setting within a portfolio and alternative strategies, and you have access to leverage, you want probably to go the way that I do with well risk managed strategy, because you want to have the risk that you expect. One is focused on performance, and I think the other one is focused on the stability of the risk that you have. It's always the quote, just control your risk and returns will take care of themselves. And that's really what I think. Because at the end of the day, let's assume you go totally theoretical there. If you control your risk enough to not have any losing day, you just have to wait, because just by luck you will make positive days, right? And so that's kind of the idea. The idea is to compress the risk to the max by diversification of systems, so that you can then apply leverage to this. Like if you look at the multistrats companies like Millennium, Balyasny, whatever, Citadel, you name it, they all compress massively their risk at the individual level, and then they apply some leverage. The average leverage for that kind of multi strategy is probably about 4, as far as I know. I've read recently that the performance of Renaissance, for instance, is it doesn't look impressive. It's not leverage, but the leverage they have compressed so much the risk on their strategy that they can leverage this 7 to 8 times. So you make, so Renaissance is known to be doing about 60% average a year, something like this. So that's, if you have a leverage of 7, that's less than 10% a year. So without the leverage, you would not be impressed by the returns. But the strategy is to compress massively the returns and then leverage, which you cannot do if you only invest in a single strategy for yourself. I agree, probably the other approach is better, just because you'll have the opportunity to capture much larger returns.
So what's your definition of risk, and what are your top 3 or 4 risk control mechanisms?
So in terms of risk allocation, I have multiple measure of risk. I use the volatility and use the value at risk, but I think it doesn't really matter, because they will give you more or less the same results. And the reason that I use multiple ones is the same reason that I trade multiple models. I'm trying to avoid the single point of failure, the bottleneck in one thing that could crash everything. So anytime I do something, I do multiple things of the same ID, so that, just one doesn't crash everything. But at the same time, even if I would use pure volatility only to allocate through risk, that would not materially change. And the other point, that the purely risk management, so that's for the allocation of risk. And that's my point about when you are trading, the difference between Total and myself, for instance, in the context of a portfolio of an alternative strategy. I think that what you allocate is not money. What you allocate is a risk budget, and it's very different. It's a very, very different approach in my opinion. So you have that risk allocation, risk contribution, or whatever you want to call it, and at the sub strategy level, one single sub strategy level, you have a risk management, which is some drawdown control, and the drawdown control is here to capture, a drawdown that is happening very fast or very slow. Basically, if it's very slow, this probably means that you have an alpha decay, and what used to work doesn't work anymore. If you have, a very fast drawdown, it can be a really very specific market situation. But that's the two main risk component that I use. The risk allocation and the risk control at the.
And do you find you still need to implement stop losses at a model level when you're taking that approach, or you don't?
So it's not a stop loss in the total sense again, I would say. It's I don't really have to trigger stop loss. And I don't have any, actually, because I don't like the strategy features that would, go on off, kind of a step function. I just don't like that, and that's the kind of thing that
You don't like binary.
No, the binary stuff, I just don't like it. I mean, it's everything. It's like in life, everything is a shades of gray. It's never truly black or truly white. So I don't see why I should be long, or full short, or flat. If there is three position in your life, I mean, you're just an extremist. Yeah, so I like, when the positions develop are smooth, and that's what I try to achieve in my systems, in my risk management, and everything. So, so sometimes I have questions about, when are you full long? My answer is always, I'm never full long. It's just the probability of being full long is zero. So everything would have to go straight up maybe for 20, 30 days. So that, yes, I have a full long position, because, everything would be crazy long. And on top of that, with a very low, quite a low volatility that would not shrink the risk. So for me, full long, full short doesn't make much sense.
That leads back to the regime point then. So you generally don't like building models that include regime awareness. Would that be fair to say?
Yeah, and by the way, another point is to have that kind of non-binary model. It's very important in terms of overfitting, because when you have that kind of binary model, this is the open door for overfitting. Because let's say you have a Duncan channel, breakout, something like this. You have in the optimization surface, if you like, this is when you have cliffs, so it gets better, and then oops, you will capture the point you don't want to capture, and then it goes back, to a very low performance, whatever, Sharpe ratio or sorting ratio or whatever. So I pay a lot of attention about overfitting, about the smoothness of the optimization surface. If there is a cliff in the optimization surface, I would discard I would reject the model. This is definitely, and this is one of the reasons why I don't trade pure breakout strategy, because you have that kind of effect. So if you move, let's say, let's say you choose 20 days look back, then maybe, and you have a big drawdown. Oh, let's take 19, and then your drawdown just disappear. It's again, that's the open door to overfitting, and I think that doing this, it's a massive risk to take.
Yeah, absolutely. Yeah. So you mentioned model decay there as well. Is there a mechanism you have for monitoring that? Because you've used the same systems for 10 years, more or less. The same principles serve you well. So what's your approach to that and to not overfitting so that you do have models with longevity?
So in terms of overfitting, this is what I just mentioned, the smoothness of the optimization surface. It's very important for me. It's very, I like to have large optimal plans of in the optimization surface. That's what I'm looking for. If I see, there are cliffs, like I mentioned, I reject the model right away. Even sometimes where the optimization surface is noisy, that's not a good sign as well.
So you're looking for a nice wide plateau?
Kind of, yes. It's not always the case. But at least if it's not a plateau, I'm looking for something that is pretty smooth, reach an optimal and go back to a non-optimal. But sometimes you can have multiple optimals. But I think that the most important thing is that the smoothness of the curve. Because this means that if you move your parameter slightly on one side, slightly on the other side, your performance will not be, significantly different, materially different. So I think that's the most important thing. And the same way that I'm doing with models, when I'm optimized, I'm not optimizing only on the Sharpe ratio. I'm optimizing on multiple, performance ratio. So for a single strategy, mostly Sharpe ratio should be enough. If you use other ones, actually, the optimal zones are almost the same, even if the values are different, obviously. But the optimal zones are very the same. They kind of lagging each other, and I'm using Kalmar ratio for instance. And what I do is that I superimpose all optimization surfaces, and then I choose the one that is the best combination of all. So
do you address the multivariate nature of your models?
Exactly, which means that the selection is never the best, the optimal for one single ratio. It's usually a good compromise between different ratios. It's not the optimal for anyone, but it's in the optimal zone for all of them.
And so model decay, like once you've built these models, you expect them to last for a long time. Do you have a process around monitoring whether they are decaying? Is that something you believe in?
So like I said, I mean, usually they last pretty long. Now, I've industrialized my process far enough, and I think well enough so that when I select a model and its parameters, it lasts me for quite some time. Specifically in the trend following space, it's just you would not have variations in the parameters, dramatic variation in the parameters. So my parameters, I don't change them much. I look at them. And the way I look at them at the alpha decay is about each model, each component of the model. If you start going into extended periods of drawdowns, this is where I start looking at it. Because again, I'm always looking at if the model responds the way it's supposed to. I'm not really looking at the performance, really, to be honest. But if you have an extended period of range trading, your model is supposed to capture a trend and there's no trend, what can you expect? So yes, you can have an extended long drawdown, but if it's expected, okay, this is a reason for me to check, but not to invalidate necessarily the model. So I see the alpha decay in the weight of the strategies, because it will be captured by the drawdown control risk management model. If you have an extended drawdown, the weight to this specific model for this specific parameter will start to go down. And at some point, there is a trigger where I say, okay, why is this model not so allocated? So I check the consistency between the performance of the model and what it's supposed to capture. If it's to be expected, I leave it as is, and I go back to what I was doing before. Or the worst that can happen for me is that you have a drawdown and that would not be expected. And that's the kind of thing that I definitely don't like to see. Fortunately for me, it doesn't happen. It didn't happen for a long time now. But this is definitely what I don't want to see. And this would tell me, okay, maybe the market has changed. Maybe there's no trend anymore, whether in the relative value space or the idiosyncratic space. And maybe there's something else to do. But my risk allocation, I believe, is, I would say, well done enough so that if you have an alpha decay, you would see a lower weight to this specific strategy, which means that at the end of the day, this decaying alpha will not take your full portfolio down, just because it will be deallocated anyway at some point. So again, for me, it's about figuring out, okay, what are the less allocated strategies? Is there a good reason for that? If there's a good reason for that, okay, I move on.
Joris, are you doing anything now in the mean reversion space at all?
No, I don't. I'm planning to, but I don't like it. Today I address, because as I mentioned, I'm going long vol on one side and short vol on the other side. The way that I'm going on short vol is through volatility, the relative value volatility component of the strategy.
Okay, can you explain that to us a little bit?
So it's a relative value strategy between VXX and VXZ, so short-term and mid-term volatility. It's a market neutral strategy, which means that it will be long or short the spread, basically. And so when everything is doing, as expected, I will be short the spread, meaning that I will make more money on shorting VXX than I lose on being long VXZ, for instance. But this is so the way to be. I mean, the funny part is that, maybe the interesting part is that the way to get to that short volatility exposure is still through the same trend following models. I capture the trend both on the downside for the spread and on the upside. So this strategy has the capacity to be short volatility and to be long volatility pretty rapidly. Because the risk is obviously on the short volatility side. Yesterday we had a spike in volatility, so I got hit, but not much. Not much. Why? Because again, you have this volatility, this risk allocation component, and so obviously the volatility strategy is much riskier than the other ones. So the weight attributed to it today, it's probably 10 to 15%. That's it. So so I probably lost about 1% on this volatility part. I made up a little bit on the other side of the portfolio, but anyway, but that strategy has the capacity to be short volatility and to be long volatility. So the risk is on the short side, and the way it works, you can capture it with a good kind of breakout strategy. Again, it's not, but kind of to understand the concept, because the volatility will spike. Whatever breakout strategy on the upside, you will capture it when you have a really significant spike. And what significant spike? What I mean is 2008, for instance, 2011, 2015, 2018, 2020. 2020 was an amazing volatility event. It was the perfect thing to capture, just because you had volatility going up every single day. When
the COVID spike.
Yes. So it was going up every single day for about 2 weeks. And so, so when you spike like this, so yes, you take a hit at the beginning. First thing that you do is to cut your position at that point. Then you have another one. So you start getting long. And when you're alongside, you make 20% on the strategy about every day. It's a little component of the portfolio, but still gives you some really nice return. And whatever strategy, breakout strategy on the upside you have, you will capture this. Again, I mean, it goes back to what we were saying before, is that what you have to focus is on the risk side. On the false signals. This is where the key is, because the key is not to do better when it's trending. I think the key is losing less when it's not trending, actually, because capturing a trend is pretty easy. When you actually have a trend, whatever you implement, a breakout, moving average or whatever, you will capture that trend. That's not the difficult part. The difficult part is losing less. And what's interesting on the volatility side is that it has two. It always worked the same way. So it's you have the volatility decay, and the VXX that is going down basically all the time, and you just don't have to get killed on a 100%, 200% spike or something like this when you're shorting. But the two sides of the trade are pretty stable. That's what makes it very interesting to trade and gives you a lot of return. So the behavior on the downside, on the short trade, is pretty, let's say, obvious, and on the positive side as well. What you have to really manage is what you do in between. When you have little spikes, but not much, and revert, and how stable. Because what's interesting with volatility like this is that you have to be very reactive, but not so reactive that you just you're just losing too much with the mean reversion within the volatility process. And I think that makes a very interesting asset to trade.
Was this developed as a hedge strategy or really as an absolute return strategy in itself?
So at the beginning, I started designing this as a pure volatility strategy, directional volatility strategy on the VXX. But you have it's pretty. You have pretty dramatic moves, that kind of strategy. You need to be ready to experience 40% drawdowns. Not everyone is ready to go there. Even myself, when I started trading this for myself, I said, when you hit a 40-45% drawdown, you start questioning yourself.
Oh, yeah.
Even if it appeared in the backtest before, 40% is quite significant. I say, okay, did I do something wrong? Maybe not. And and that's basically the thing that you have to master is controlling your emotion. Even if you have a system, when you look at your losses and they accumulate day after day up to 40-45%, you have to be strong enough to say, okay, no, this one is doing the right thing. It will come back. And just to be honest, with you, when I had this drawdown, when was it? It was 2021. I don't remember exactly when it was, but when I had this 40% drawdown, I cut my position at the time. And it was the most stupidest thing that I did. What the worst part is not trusting myself. And the funny part is that you always question yourself, even if my strategies always recovered. I had significant drawdown in my careers, but they always recovered. The only issue is that when your manager is not ready to wait for the strategy to recover. But that means that, probably my biggest issue was that at some point I was not trusting myself enough. And I try not to do that again anymore. But the volatility started as a really VXX strategy, only purely directional, because I wanted something that could make a lot of money pretty fast on both sides of the trade, short and long volatility. This strategy actually works pretty well. Even if the drawdown. So I came up with this idea of, instead of trading VXX only, trading the spread between VXS and VXZ, which allows me to mitigate some of the movement, and makes it actually more tradable, easier tradable, just because you remove some of the noise actually. So that suddenly becomes more tradable, and the trends is somehow easier to capture. But the initial strategy that was purely on VXX, this is how I derived my tail risk hedge. And it was really simple thing. You have, this volatility strategy, and when the long position is above a threshold, then this is when the tail risk is triggered. As simple as that, actually. And it works pretty well. It has been working pretty well in 2020. Really good. Captured the thing. I'm pretty happy about it.
Nice.
As a tail risk hedge, because I have a tail risk hedge, basically, that doesn't suffer the constant losses that you have when this happens. And to be able to do that, you have to have a signal that tells you when the volatility is going up.
And Joris, I believe you're a registered CTA. You have your firm Quantaraxia. What are you up to these days, and what are you offering to the world?
So what I'm into is I started this company in 2020 with tactical asset allocation strategy. I was mostly offering what I was asked to do, because my framework for developing and designing strategy, like I said, can be applied to universally to about anything. So if you ask me about something, I can probably do it. So I did this for my client that were coming to me. This year, I revamped my offering. I said, no, there are these things that I just don't want to do anymore. And now I'm rebuilding my CTA and my market neutral crypto strategy. And that's what I want to offer now, and don't do much besides that, right? That this is the ones that I want to build. So I closed a couple of accounts recently, just to be able to focus on this. And so I started my, again, CTA, ETF-based CTA, which again is a component of a pure trend following CTA, a tactical asset allocation, and the relative value volatility strategy. I started this on October 1st. So I will be 3 months in at the end of the year. I'm pretty happy about the result. My benchmark is obviously the CTA index. And my objective is to outperform the CTA index, obviously. And I think I can do it.
Awesome.
So, for instance, first month, October, I made about the same thing as the CTA index, down. So in November, I was flat when the CTA index was down 3 something. And this month so far, I'm up 2 point something when the CTA index is flat. So this is the kind of overperformance that I'm looking for on the strategy. It's obviously heavily influenced by momentum. So it's natural that I have some correlation with the CTA index, given that I trade the same universe. with the similar styles of strategy, even if I, it's a little bit more diversified. But my objective is to overperform the CTA index, and I think that I can do it.
And look, we're running out of time, but you've mentioned crypto, and I forgot to bring that up. So can you quickly tell us about your crypto trading?
So crypto, I started this with a client a couple years ago on the long only side before actually, because you had to be long only. It was a good trade when the market was only going up. Then come 2022 and you have, big drawdown. So the markets, so my strategy has evolved during that time. And again, just so the same way that was trading crypto in one way, I try to trade the same thing in many different ways. So that's how I started again trade cryptos in relative value. And develop the strategies on this. And
do you have a very big universe of tradable cryptos? Do you try to stay on a single exchange? Do you just trade the top 10 or 20 or one or two?
So that's the top 15 actually at the moment.
Yeah,
it could be the top. It used to be 25, but top 15. That's enough. And it's a market neutral relative value strategy. Basically, it's again momentum applied to pairs. Basically, so by construction, it's a market neutral strategy. And this one is traded on a daily basis plus an intraday component on an hourly basis. And again, the same process that I use on daily trades, I implement the exact same process on the hourly frequency.
So I've got to ask about relative value in crypto, because I would imagine all crypto as being very similar. I guess there are different purposes for different coins. And is that how you bucket them into categories? Because, like, say, those are the ones that are like NFTs in that bucket, or currency.
No, I trade all the pairs within a trend following framework. I don't do any, specific, but you get some trends within the pairs. If you look, for instance, at Bitcoin Ethereum pair, for instance, recently, Ethereum has been underperforming Bitcoin. So you have a trend that is pretty nice. At the moment, you have others developing. You have, Cardano that has been performing really well. Solana maybe as well recently. So you have trends developing in the relative space.
Do you think this Bitcoin bull run is the end of the dark period for crypto, and it's going to be another big run back to 100,000?
I'm really positive about crypto because even the guys that are saying they don't like crypto, they are actually moving towards it. Specifically Bitcoin. You had Jamie Dimon recently saying at a hearing at Congress, so it banned crypto. At the same time, JP Morgan is increasing its presence in the crypto space. So so his words doesn't match his actions. And when I have to, assess what someone is saying, I'd rather look at what he does than what he says, right? And today, so all the big names, if you have BlackRock going to crypto and you have JP Morgan going to increasing its presence in crypto, despite what Jamie Dimon says, that tells me that there will be some larger adoption at some point. So what the price will be, I don't know, but I believe it will be very high, just because we are still at very early stage of cryptos. How many people own cryptos these days? Not so much. So for me, this crypto space is very interesting, because I think, to me, I don't see this, especially in terms of trading of an investment. I really think about this in terms of store of value. Today, if you ask me if I prefer having my money in crypto, in Bitcoin or in US dollar, I would say Bitcoin. Not because I think that Bitcoin will go to the roof, But I think that the US dollar will go down with inflation, with printing. They have already announced that. So you have a slightly dip in inflation. So they are pushing this soft landing narrative. And so give them a good reason to be able to lower rates again, pretty soon, 3 to 4 times in 2024. But it's not because that they can. It's because they have to. If you look at the unrealized losses that the US banks have, the slightest bank run on banks today in the US would collapse the full sector. This is what happened, in SVB, for instance, in March. That's what actually happened. You had, I think it was Peter Thiel that sent a tweet or something and a couple of emails to his best friend. So you had a slight bank run on SVB that collapsed the bank at the time because they had to realize their losses on their treasuries. And so in that there was another bank where it happens as well a couple of weeks after that. And you had other banks coming at the rescue, reinjecting about 60 billion into this bank. It might be First Republic something. I don't remember exactly the name. But they didn't do it because it was an investment. They did it to avoid the contagions to other bank. That bank was maybe $50. It was quoting $50 at the time when it started happening. Now it's the value, the stock value is a few cents. So it was definitely not even an investment. They did this to stop the contagion. Now, if it would happen again, you just could not stop it. So they have to take these rates down so that the unrealized losses on their treasuries are not as much. So that if they are slight bank run, it would be more manageable for them to save them. Otherwise, I believe this would be a total collapse of the banking sector right now.
Rich, have you got anything to end with? Because this has been a very long show as it is, and we should start to wrap it up.
No, I think it's been very interesting. It's been great to speak with you, Joris.
I speak too much. I'm sorry about that.
No, we've loved it.
No, it's all good.
No, that was very interesting to speak to you. I mean, it's very nice to meet you on this show. I mean, I've listened to quite a few of them. I mean, it's really interesting because, like we discussed before, you have a very large, wide panel of people with different approach to the market. And it's very interesting because, again, anytime you listen to one of your podcasts, you actually learn something.
Great.
Not even for retail, but even for professional. Like I mentioned at the beginning of the show, that's how I learned, by listening to other managers, the way they were doing. And I still learn, and I still want to learn about what other managers are doing, the way they are running and developing their strategy.
Well, that's why we started the show too, because we want to learn and talk to others in the field and promote this space in general. And it's great to have us all talking together. I, for one, am a big fan.
I mean, I think you're doing a great job in terms of education because investors definitely need that education part on the CTA and at least the quantitative space. This is, I believe, one of the biggest hurdle of investing with a quant, because very often so this guy is aligning lines of codes and equations. I have no idea what he's doing, but it's supposed to be making money. Usually that's when it's as a quant you cannot tell a very nice story about the stocks that you've seen and they're doing this and this. You just can't do that, right? You have your models and you live and die with it, but you just cannot, run fancy stories about the latest development in that company. It's just
hard to make numbers interesting.
Yeah.
Well, Joris, let's
make numbers interesting again.
Let's end with you telling the listeners and viewers how they can get in touch with you, and anything else you'd like to let us know about your offerings, your websites, your LinkedIn, your Twitter, and so on.
I think the best way to get in touch with me today is to go through my LinkedIn profile. This is where I spend most of the time. My website is in limbo, kind of, at this time. I designed this a long time ago. I didn't change much, but I mean the information is still relevant, but it really needs to be refreshed. To
That's
be honest.
okay.
And
What's the domain?
If they want, sorry, that's quantaraxia.com.
Quantaraxia.com.
Correct. Yes. They can check there, but the best way to join me is through my LinkedIn profile. And I try to post more or less interesting things every day. So if they want to know a little bit more about me, about what I do, it's probably where they will get the most interesting, more accurate information.
No, I follow you on LinkedIn, and it's good to do. All right, let's wrap it up, gents. It's been a fascinating show. We've covered a lot of ground, and there's going to be plenty of material here for those who can sit through it. If there's nothing else, we'll say farewell until the next time, but look forward to the next time.
Thank you very much.
Thanks,
It was a pleasure.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.